Hello, welcome to the audience. My name is Asif Adnan Rashid. Have a good day to all. Thank you, Professor Arif Fazal Sir, for his invaluable guidance throughout the course. Today, I will present the report on the merger of five Islamic banks and strategic consolidation to stabilize financial sector. So this merger came as a response to critical weakness in five Islamic banks. They are Social Islamic Bank, Global Islamic Bank, First Security Islamic Bank, Union Bank, and the EXIM Bank. They faced a huge non-performing loans, almost 2 lakh crore taka, which officially reported as 40,000 crores, almost 5 times higher in reality. Needless to say, that this deliberate politically motivated move exposes weakness in banking governance. That's why Bangladesh Bank had to step in. The government and Bangladesh Bank initiated a merger to prevent collapse and stabilize financial sector. So to begin with, the Islamic banking plays a significant role in Bangladesh, serving millions of customers with high profit margin other than non-Sharia banking system. They have 25% banking asset in Bangladesh. However, weak governance and risky lending practices pushed them to near insolvency. So the financial, operational, and integrational challenges can be reduced with consolidation entity. This study focuses on financial analysis of the merger and the risk factor, forecast, and long-term implications. So the financial analysis of the merger. So these slides highlights the crisis of this bank was not only just financial, but also rooted in governance failure. According to the forensic audit, the KPMG and EY audit firm, the actual situation of these five banks is much worse than what was officially reported. The bank gave loans of 2 lakh crore against deposit of only 1.5 lakh crore, creating a dangerous deposit asset gap. The liquidity coverage ratio was 50%, means the overall asset cannot cover their liabilities. Liquidity distress was severe. The bank reserve falling 90% year on year. This indicated that customer started losing trust and withdraw their funds. So from the financial analysis, we can decide that while the merger address the liquidity and the solvency in the short run, but the long-term stability depends on entirely governance, structural reform, and managing micro and macro level crisis. The micro level crisis means the poor leadership and weak risk management. And the macro level crisis is the supervisory shortcoming to the board members and the overall political influence to operate banks as their personal money-making institution rather than public trust. So the risk assessment, this merger offers stability, but it offers also stability with risk. In short term, this risk mainly liquidity pressure. In long term, this is mainly the loan recovery, as well as the fiscal burden on government will rise. And the worst thing is that if it fails again, it directly impacts on our health sector budget from our national GDP. So the comparative study from the table, we show that in India, for example, several public banks were merged to create stronger entities. Malaysia went through large-scale banking consolidation after Asian financial crisis. On the other hand, some countries attempted merger without addressing governance failure, ended up with large unstable institutions. So lesson for Bangladesh is very clear. While merger can stabilize bank in short term, but long-term success will come with governance reforms and transparency. Some strategic recommendation. The first priority is governance reform. And second, the financial strengthening and digital integration, which is critical. Creating an asset management company to handle toxic loans will reduce pressure. Third, the loan recovery must be aggressive and strategic. Specialized financial court, fast-tracking cases, and focusing on top defaulters, making them socially boycott using name and shame strategy will essential to restoring solvency and public trust. So as we conclude, it is important to see the merger is both rescue operation and reform opportunity. In the best case, is government reforms well, it trust builds back to the depositors, it transforms into a strong regional Islamic mega bank by 2030. But in worst case, if reform fails, non-performing loans remain unresolved, the super bad bank draining public fund and putting our health sector budget at significant risk. So final takeaway is clear. The success of this merger depends on three factors: governance integrity, structural reform, and public trust. Bangladesh Bank gives us the window of opportunity, but only through transparency and accountability can bring this stability and resilience to the financial sector. So thank you very much for your time and attention.